The only businesses worth investing in are those that have durable competitive advantages. But how do we spot those types of companies? That's what we're talking about today. Let's find some value. We're investing in companies for the long run because we want them to compound in worth over time. But that's only possible if a company has a moat, a unique advantage that allows it to create value despite facing economic pressure. As we showed in the last lesson, there are a few key advantages that allow companies to develop moats. These include brands, scale efficiencies, network effects, and switching costs. But regardless of what the moat is and how it's been developed, companies that have durable moats all have one thing in common. They have solid financials. That's because the ultimate test of durability is whether or not a company can consistently produce raw numbers that prove that it's maximizing value for customers and also creating residual value for business owners. So spotting a good moat isn't that mysterious, and it basically boils down to 4 dimensions. Here's what they are. First, is the company invested in its own growth? In other words, is it interested in developing or acquiring assets or creating capabilities that allow it to remain durable and competitive? The yardstick we'll use to assess this criterion is called the reinvestment rate. Here's a second dimension. When the company generates or acquires those assets and capabilities, do they actually work and do what they're supposed to do? In other words, do they generate excess returns? The benchmark we'll use to figure this out is the ROIC and the ROE, or the return on invested capital and return on equity. Now, a company can have a strong reinvestment rate and have a strong return on capital, but still remain stagnant in terms of its value creation. In other words, revenue can remain flat despite a strong reinvestment rate and a strong ROIC. But that's not ideal. Ideally, we want to own companies that are hungry to deliver value and that are constantly fighting for more market share within their space. We can determine that by looking at a company's revenue growth. And lastly, value creation needs to be sustainable. In other words, companies just can't burn through their cash and resources in order to sell more of their products and services. There has to be some residual value left for business owners, and that residual value has to increase over time in order to fuel more growth. We're going to measure this last criterion by looking at the company's earnings growth. All right, so let's dive into each of these, starting with reinvestment. Reinvestment is a percentage of after-tax operating income that a company puts back into the business in order to make it grow. We calculate this as capital expenditures minus depreciation plus changes in working capital, all divided by NOPAT, or net operating profit after taxes. Now let's discuss each of these components, starting with the numerator. CapEx tells us how much the business spent on big assets or capabilities, like factories and machines, or in the case of technology companies, like research and development. For tech companies, R&D shouldn't be treated as an expense. It should be capitalized because that R&D produces assets that generate returns. Now, in order to capture new capital expenditures, we subtract depreciation and amortization. By doing so, we can estimate how much the company spent on new assets and capabilities to fuel growth, because if we don't subtract depreciation, then we fail to account for the fact that a large portion of capital expenditures often goes to replacing old or worn-out assets. We also add in changes in non-cash working capital, because that is capital that is locked up in the business. It's capital that the business absolutely needs to operate day to day. As a reminder, working capital is current assets minus current liabilities. It's money that finances the company's imminent obligations, whether that's delivering on promises to customers or paying back creditors or paying off other bills. So that's the numerator, and essentially what the numerator represents is how much the company is plowing back into the business to fuel new growth. Now we divide all of this by net operating profit after taxes. Why is that? Well, NOPAT tells us what the company's profit is from just its core operations. This is different from net income, which takes into account non-operational expenses and gains, like interest expense or gains from investments. And so by dividing the numerator by NOPAT, we're computing the proportion of the business's raw profit that is put back into the business to continue to make it grow. This is a great measure of how interested the owners are in growing the company. In general, the higher the reinvestment rate, the better. It means that the company is prioritizing long-term growth over immediate payouts, and that it's willing to forego income now in order to ensure that the business is secure and continues to compound in value in the long run. But here's the caveat. Higher reinvestment is better only if the company is able to create value with what's being reinvested into the business. If the company reinvests money into the business and acquires assets and capabilities that don't do much for it, then that reinvestment is actually a waste. That's why we want to look at reinvestment rate and ROIC. ROIC measures how efficiently the company allocates the capital it has to generate profit from core operations. The formula for ROIC is NOPAT divided by invested capital. We already know what NOPAT is, so let's focus our attention on invested capital. There are two perspectives that we can view invested capital from. The first is the financing perspective, which looks at where the business's capital comes from. In this sense, invested capital is equal to total debt plus total equity minus cash. We subtract cash because money that's just sitting around in a bank account isn't actively invested in the business. We only want to consider the capital that the owners have deployed to create value. Now, the operating perspective looks at what that capital was actually spent on, like machines or inventory or factories or other value-creating assets. From the operating perspective, invested capital equals fixed assets plus net working capital minus cash. Again, we subtract cash from working capital because it isn't being deployed to create returns. And so when we put all of this together, ROIC tells us the rate of return the company's productive capital or productive assets are actually producing. In other words, for every dollar put into the business, how many cents of after-tax profit did it actually generate? And of course, the higher the ROIC, the better. Now, what is a good ROIC? Some general rules of thumb are that a base minimum ROIC should be around 7 to 8%. A good ROIC is around 10%. And a strong ROIC is 15% or more. But really, it boils down to the return the company is able to generate compared to its cost of capital. Remember that capital comes at a cost. Debt costs the company interest payments, and equity costs the company ownership, which also has value. And so if the return on investment is lower than the cost of capital, then no matter how high the absolute value of that return is, the company isn't creating new value. It's destroying value. But if the return on investment is higher than the cost of capital, then the company is creating value. And we want a company to do that consistently and also at higher excesses. Now let's take the reinvestment rate and ROIC a step further. What we want to see is a company reinvest at high rates and also produce a high ROIC. If the company keeps plowing money back into the business and that money keeps producing excess returns, then the company is able to generate more and more value. That's exactly what we want to see as long-term investors. And so if we take the reinvestment rate and multiply it by ROIC, that tells us how much larger the company's NOPAT will be the following year. We refer to this as the company's fundamental growth. And as long as ROIC is greater than the weighted average cost of capital, then the fundamental growth represents profitable growth, growth that actually increases the company's intrinsic value. So as investors, we're looking for returns on capital that are greater than the cost of capital, and a fundamental growth that is consistently high. All right, so let's move on to the last two criteria that we're going to use to assess moats quantitatively. A company can have a strong ROIC and strong reinvestment rate, but still not create value in its market. In other words, a company can have strong fundamental growth, but not increase its top line, its sales, or its revenues. That's a problem in business, because if a company is becoming more profitable just by cutting costs and increasing its operational efficiency, that's not a sustainable strategy for improving profitability. Ultimately, revenue tells us how much the company is actually increasing its market share and providing more and more value to customers. And in business, that's really important. That's where revenue CAGR comes into play. CAGR stands for compounded annual growth rate, and it simply represents the average growth rate that a company can achieve each year over a certain period of time. The formula for CAGR is beginning value divided by ending value, all raised to the 1 over n minus 1, where n represents the investment period in years. Here's a quick example of what revenue CAGR looks like. Let's say a company achieved revenues of $100 million in a certain year, and 3 years later it achieved revenues of $250 million. Well, we take $250 million divided by $100 million, raise that to the 1 over 3, and then subtract 1. The result would be 35.72%. And what that means is that the company grew at an average of 35.72% per year over that 3-year period, assuming that it took all of its earnings from each year and reinvested them into the next year. So what we like to see is a strong revenue CAGR for any business. That shows us that value creation is sustainable, that it is coming from expanding market share and providing more benefit to customers. Ultimately, that's the engine that fuels profitability. Now lastly, we also want to focus our attention on profitability, because profits tell us the value that the business generated for owners during the period. So in addition to revenue CAGR, we also want to look at EPS CAGR. In other words, the compounded annual growth rate in earnings per share. As we learn in the next couple of lessons, investors often value companies based on their earnings, using the PE ratio. And so companies that can grow their earnings per share over time are also more likely to compound their intrinsic value over time. Now, what are good benchmarks for revenue CAGR and EPS CAGR? This depends entirely on the industry the company is in, its size, and its stage of maturity. Whenever we assess a company's revenue and earnings growth, or even its ROIC and reinvestment rate, we need to compare those metrics to those produced by companies similar to it. Ideally, we want to invest in companies that have strong revenue and earnings growth compared to their immediate peers or the industry at large. Now, when we look at any of these metrics we've discussed, we also want to look at them over long, medium, and short-term horizons. Some time horizons that are useful to measure each of these are 10 years, 5 years, 3 years, 1 year, and 1 year forward-looking. This is very similar to an approach that is taught by Phil Town in his book Rule Number 1, which I highly recommend. Town looks at his big 5 metrics, 3 of which are included in this framework here. He looks at ROIC, revenue CAGR, EPS CAGR, book value growth, and free cash flow growth. We're going to discuss those last 2 in our next sequence, which is about valuation. Alright, so that does it. We now have a simple framework for seeing moats in the numbers. Again, the 4 metrics we want to look at are the company's reinvestment rate, its return on capital, either ROIC or ROE, and then we want to see if those reinvestments and returns translate into top-line growth through revenue CAGR and profitability through EPS CAGR. In the next lesson, we're going to dive into what is arguably the most popular part about stock research and investing, that is computing intrinsic value and valuing companies. We're really looking forward to it, and we'll see you then.